Good afternoon, everybody. My name is Peter Fry. I'm the senior tax consultant here at PFP. We have the lovely Liz Maher helping us today with some topical VAT update, which will be very interesting. A couple of points to start with before we go anywhere. An email will be sent out tomorrow with a recording and the slides, so you'll get this again, so you can look at it in your leisure. And if you've got any questions, could you put them in the Q&A box and we'll work from those and see where we are and give you some thoughts. So without ado, let me pass you over to Liz and take you from there. Okay, Liz?
Cheers. Thanks, Pete. And lovely to be invited back. This is turning into an annual event for me, so hopefully it's something that you're enjoying. So yeah, welcome everybody to the wonderful world of VAT. For those of you who sat with me before, you'll know how much I love a chat about VAT. So it's always a pleasure. We've got about an hour. I've put together a couple of topical areas in terms of what we're seeing as an indirect tax team within the Zenadin organisation. For those of you who've met me in the past, you might be familiar with me. I was that partner at Centurion VAT, a specialist boutique firm, and Centurion joined the Zenadin consolidating model a couple of years ago now, 4 years I think, and it's been a fantastic opportunity for us to work increasingly across the UK and beyond into overseas areas now to help clients. So yeah, Liz Maher, Welsh, female, can talk for Britain, and do try to talk about a little bit about VAT. So what have I put on the topic for today? Well, hopefully I've picked off a couple of areas, because obviously you're all in diverse areas of activities. So I've tried to think of the things that are interesting, but would be relevant as well. So I'm going to touch on residential property, because whether you deal with larger corporates or you deal with owner-managed businesses or even private individuals, you know, there's often investment streams that they're looking at around residential property. So I'm going to touch on a few topical bits in that area. Increasingly, I think it's worth us making sure that we as advisors and you as practitioners out there really do understand the issues around the option to tax. So I've put a bit of a refresher in there. Sorry if it's old, news to some of you, but from the errors that I see arising, I think it's important that we do make sure we've got a good basic understanding of that. VAT in education. Now, as you know, we're specialists in the education sector as well as in the not-for-profit sector generally. So there's a couple of angles to the education. I'm not going to concentrate on the independent schools necessarily, but I'm going to touch on the wider impact of the changes that we've had into academies and FE colleges. So a little bit in there that hopefully might pick up client activities that you're involved with. Very quick touch on the EU 2015 changes. Just literally, as I say, just a reminder that, okay, we're no longer part of the single market. We've basically implanted the European VAT legislation into our UK domestic legislation, but we still are going to see our clients affected by VAT changes that are taking place across Europe. I'm not going to dwell on the electronic invoicing and those side of it, but two specific changes that came in from the start of this year. And then my final bit is around care homes, because I know across the Zenadin network, we've got an awful lot of clients. So I was guessing that you too might be dealing with clients in that sector. So just to make sure you're alert to those things. I'm happy to take questions. Pete will keep an eye on the Q&A box, so don't hesitate. And please, there is no such thing as a silly VAT question, okay? So if you're sat there thinking, no, I'm not really sure I understood that, but I feel a bit daft asking, please ask, because it always unlocks a germ of a thought and is of interest. So please don't hesitate to sort of chip in and join. Now, I'm aware this is being recorded, so obviously this is all information that's relevant as of this date, which is the 13th of May. Things will change and frequently do at some speed. In the context of VAT, I think it's still important to recognise that whilst we've got what they refer to in politics as the triple lock in regard to changes on the VAT revenue generation, you know, VAT does generate a huge amount of tax revenues in terms of supporting government spending. So even if we were to look at the figures, which were slightly down for 24 on 25, we're still looking at VAT generating 165 billion pounds of revenue, second biggest tax generator, twice as much as you generate around corporation tax. And that really, you know, it gives some basis for the focus that we're starting to see ramp up again from HMRC in terms of their rolling compliance. Now, I think we'd all agree that in the last sort of, you know, post-COVID couple of years, we'd seen HMRC retrench back into their office space, as many of us, you know, indeed did. But we are now, with their additional recruitment, starting to see them come back out with much more of an active compliance programme. So whilst you might not get physical visits, we across our client base are starting to see an uptick in the questions that we're getting and the reviews that are being undertaken. So I think it's really important to take advantage of access to these sorts of updates that PFP provide you to make sure you keep on the front foot in terms of delivering value to your clients. So when that knock on the door comes, you know, you at least know the direction of travel from HMRC, which is protection of the revenue, and quite active protection of the revenue that we're starting to see. So in the context of residential property, I've picked up on one of the particular cases, which is Sonder. And that's particularly because of the way it interacts with the tour operators margin scheme. So I'm not sure if any of you are familiar with the Sonder case, but it came through the courts early part of this year. The decision came out. It had been through the first tier tribunal, and it had gone to appeal in January to the upper tier, and they put their decision out, which was to disagree with the first tier and basically come back to agreeing with the position that the revenue had taken on it. So let's just consider what is Sonder all about. So Sonder leased a block of apartments, and they used those self-contained apartments in order to make those available to people for short stays. Now, the importance about this in terms of the tour operators margin scheme is how much of the supply is subject to VAT. And for those of you who are familiar with the tour operators margin scheme, the important word in there is margin. And therefore VAT is due on the margin as opposed to the full value of the supply. So for Sonder, it's a question as to how much VAT am I taking out my consideration I'm getting and handing over to the revenue. If it's that on the full value, obviously that's a bigger sum. If it's that on the margin, that's a much smaller sum, which means I'm keeping more, value for myself. So, as I say, Sonder argued that although it was obtaining a lease on these blocks of apartments and then subletting those apartments, it was acting as a principal, which is one of the conditions, not as an agent, and the supplies that it was making should have been able to be included within the tour operators margin scheme. Now, as I say, HMRC initially agreed. Once we had a decision that they were disagreeing with that, they went to the first tier tribunal, and the first tier tribunal agreed with Sonder and felt that, yes, Sonder's argument that the supplies it made to the travellers of this accommodation was for the direct benefit of the traveller. And they also supported the case that Sonder had put, that, which is fundamental to Tom's, is that there was no material alteration between what they bought in and what they supplied on. So we're not sort of talking about, in essence, what the nature of the supply is. We're talking about the conditions that are relevant to it qualifying as a tour operator's margin scheme supply. So obviously the question was, does this sound right? If you have a look at the meaning of the word of supply, then clearly, yes, no one was arguing that Sonder weren't making a supply, but what Sonder were arguing was a type of the supply that they're making did it fall into the criteria to be a tour operator's margin scheme? So that was the sort of basics of it. And when it came to the upper tribunal, they then looked at, well, if a supply to Sonder was that supply of the landlord to Sonder of the lease in the block of apartments, was that supply for the direct benefit of the traveller? And the answer, you know, within the upper tribunal's consideration was no. What you have is a supply of an interest in land from the landlord to Sonder, and what Sonder is making is a supply of accommodation to the traveller. So yes, there is a traveller involved in the process, but it isn't Sonder as the traveller. So the upper tribunal agreed and said that the first tier had basically erred in its original decision. Now, on that basis, obviously it was bad news for Sonder, because they'd only been accounting for VAT on the margin that they'd accounted for, as opposed to what this case is arguing is that there should have been VAT on the full value. Now, I am skipping through these slides. As Peter has already said, you will get a copy of these slides and a recording. So, you know, take the opportunity to, you know, to read through them at a later point. And if you have any questions, then obviously you've got my contact details, and you can get in touch. So as I say, the impact of this is, I think you should be looking at the ways, if you've got clients in similar situations who are involved in holiday accommodation, furnished holiday lets, have a look at the way in which this case would impact it. It might be it's their own property and they're making it available, but you know, you might have more entrepreneurial clients who are buying in blocks of accommodation in order to turn it on its head and make a supply of hotel accommodation or similar, which is effectively taking it into the standard rated area of activity. Now, obviously, we look at ways to restructure. If we're left with a decision as it stands, we might look at ways to restructure the supply so that we can get away again from having to account for VAT on the full value of the charge that Sonder in this case is making to its customers. But always with VAT, we have to be cognizant that you know, it's the facts of the case. So what's the commercial arrangements? What's the reality? And are there ways in which we could mitigate or create a structure where VAT could still be due on a smaller value, perhaps on an agency fee arrangement rather than the full value of the supply? Clearly, having won this case, I would expect HMRC to be looking for other businesses in the same situation. So again, this is part of these updates, to give you thoughts as to being proactive with your client base and taking out the messages as to, hang on, guys, not saying you're going to get a call next week, but you may well get challenges about this. Sonder, obviously, it's gone through first tier, it's gone through upper tier. Upper tier creates a precedent, so it's a point of fact of law that can be used. But Sonder, I've checked again today, and they have gone for leave to appeal. They've been granted leave to appeal, so they will now take this up to the Court of Appeal to argue their case further. And what they're arguing about is that the economic reality of the arrangement is that whilst the upper tier said there was a material difference between what Sonder was getting and what Sonder was supplying, in economic reality there wasn't. So it's going to be on those technical points that they're going to go to the Court of Appeal. So as usual with VAT, it's something to watch out for, and might even appear on next year's update if we've got a decision at that point. Peter, I see you've got your hand up. Do you want to bring any questions into the conversation now?
I've got a question for you.
Yeah.
I know, because I get the calls, a number of people have set up systems where individuals have been owning numbers of houses that they rent out, either short-term or long-term. Particularly now, it's going to be an interesting one with the changes that we're just about to talk about on furnished holiday lettings. But what they're doing is they have set them up, and they've set up a separate company who does all the letting for them. which effectively is what we're talking about here.
Yes. Yeah. And that's one of the opportunities that I see. So you're actually restructuring what the supply is. You're not arguing about what is the supply. You're changing the nature of the supply from the actual role is of a letting agent, not as the principal in making the supply of that furnished holiday accommodation.
Yeah, I think you've got to be careful both sides though, and make sure that you're doing it for good tax reasons, because I think the revenue could attack the other side of it if you're not careful.
Yes, and you've got to have commercial reality. And the commercial reality might be competition and price point in the marketplace. If you have to, you're selling in supply plus 20% VAT into a competitive marketplace. But Peter, you're absolutely right. And it's a point that comes back into the care home issue at the end, in terms of, is this, tax avoidance? Is it deliberately done? And the only reason it's being done is to reduce an output tax liability.
Commerciality is sometimes a difficult thing to argue, but you've got to make sure your plan is in place before you even consider this.
Yeah, absolutely. Right. Thanks,
Sorry,
Peter. No. Always good to hear from you, Peter.
Okay.
It just picks up on the final aspect, which Peter mentioned just then. Is I'm aware, because obviously Zenadin has a large private client portfolio. You've got a lot of changes on the direct tax side, particularly around furnished holiday let. So I just wanted to make sure we weren't forgetting about the VAT implications of structures or changes that you as advisors might be talking to your clients about. Even in the context of inheritance tax planning, moving assets around, I've seen instances. It's amazing me, but that tends to get forgotten about sometimes. Obviously, not everybody has a Liz sat in their office to go, hang on, remember the VAT issues here. So just to alert you to those, if you are looking at clients who are going, right, okay, tax concessions gone around furnished holiday let, I'm going to go into short whole tenancy arrangements, letting 6 months or more, you're actually changing the liability of that supply. So you're saying that supply is no longer of holiday accommodation, which would be automatically taxable. It's not about an option to tax. It falls outside of the exemption. And you're taking it from that automatic standard rating into a grant or an interest in land, which is within the VAT exemption. So if you're moving from taxable to exempt activities, your immediate thought process should be, what's the impact on the VAT recovery position that client has incurred? Now, that might be quite significant if, and I have seen a number of clients spend an awful lot of money on their holiday home lettings. It might be because there's a bit of, they wanted to use it themselves as well, so they want a high-end spec. But please do not forget about that capital goods scheme value, which is effectively saying if you spent more than £250,000 plus VAT on a refurbishment, build, whatever, then that VAT claim that you originally made, because it was wholly related to taxable lettings, if that's within a 10-year period and the use changes from being taxable as holiday lettings into exempt as residential lettings, you are going to face a VAT adjustment under the capital goods scheme. So it's less of an impact issue in terms of historical capital expenditure if the expenditure was under £250,000, but even going forward, there will be a revenue spend impact because, it was taxable activities. From that date onwards, it becomes exempt. Therefore, input tax, VAT on costs incurred from that date onwards will relate to an exempt supply. So when you're doing business modelling, please don't forget and don't assume that the VAT position is going to stay the same. Now, I would just note as well, there is going to be a change in the value of the capital goods scheme value. It was part of the Office of Tax Simplification review that it should be increased, because this value's been at 250 since it came in, which I think was 1990. And prices have obviously gone on. So a week or two ago, the announcement was made that they would be uplifting the capital goods scheme value to 600,000 in terms of capitalised spend on a project, but that's not retrospective, and we have not got a date as to when that 600,000 benchmark comes into play. So again, an added bit of an update information for you on the capital goods scheme. It is going to change in value. Look out for when it does. And please do remember that for capital goods scheme purposes, we're talking not just about the value of the build costs, but we're talking about for professional fees in relation to, you know, the site design, might even be costs relating to buying the site if that was incurred on it as well. So yeah, a couple of things around capital goods schemes anyway. But in the context of furnished holiday lets and what you're advising your clients to do, please don't forget this move from taxable income as holiday lettings to exempt income as short hold residential lettings. So important, as I say, and just of that final bullet point, I have seen situations where people perhaps have been rushing to get deadlines met in terms of inheritance tax planning, and have moved properties from one, you know, parent down to children, and they were business activities, but they completely forgot to consider the VAT implications of what they were doing, the transfer going concern routes, etc. We had one client with an unexpected £35,000 VAT liability because the aspect of that hadn't been considered when they did their inheritance tax planning. So a couple of little bits and pieces around there. I would also, while I'm on the subject, mention other issues around serviced accommodation, serviced apartments. There was the Real Reed case, which dealt with a block of apartments, quite a couple of hundred apartments. I think they're Chelsea Cloisters, I think they're called, in London. But that was a case that says, well, was the supply of these serviced apartments exempt, which is what the client was trying to argue, or were they actually taxable, which is what HMRC were trying to argue, because they were similar to hotel accommodation. So it didn't have a sign saying it was a hotel, there was some catering involved, but there were facets of that contract. You know, the flat was cleaned up at the end of the stay, linen could be provided, that made it cross that line into, hang on guys, you know, I don't care that this is a 6 months let, it's actually serviced accommodation similar to that you'd get in a hotel. So as you can see, there's quite a number of aspects to consider when we're talking about residential property lettings, what they are, how they're held out, and then the interaction with the TOMS side. Pete, I don't know if there's anything else on that first section you want to bring in, or shall I carry on to the next section on options?
Keep going, Liz. That's
Cheers.
fine.
Thank you. Right. Option to tax. This, as I say, is a bit of a back to basics on the VAT side, because it just continues to crop up. So I'm apologising in advance if I'm telling my grannies and granddads how to suck eggs, as they say, but I just think it's important to start with the basics and just pick out where we're seeing issues crop up and create errors. So for those of you who are new to the wonderful world of VAT, what is an OTT? What is an option to tax? Well, it's a mechanism, it's a positive action that you, the taxpayer, can take, and it would change what would have been an exempt interest in land into a taxable interest in land, and it's always taxable at the standard rate. So it doesn't take it to the reduced rate or the zero rate, it takes it to that 20% rate. Now, it doesn't apply to all types of buildings, but if you've got land or buildings that are regarded as commercial buildings, then you can opt to tax your interest in owning that, the leasehold or the freehold, and it will make the supplies that you grant in it taxable. And obviously that's really useful, isn't it? Because if you're a landlord and you're faced with some refurbishment costs in order to make the place more marketable, you're going to incur VAT on those costs, and you know, you want to be able to recover it. But having made that decision, we really do need to be very careful about the process of opting, make sure we do it properly and understand the implication of it, because it is one of those, you know, it's for, well, for life, not just for Christmas. I mean, it's not quite entirety of life, but it's got a longer period than a lot of people consider. So it's a 20-year interest that the option covers. So once you've opted, so you opt from the 13th of May 2025, and subject to other conditions, that option is in place for the next 20 years. You can revoke it at the end of those 20 years. It doesn't automatically fall away. I think that's an important point to make. You actually again have to do a positive action if you're going to revoke the option at the end of that 20 years. And it might be that you look at your clients' portfolios. I think the first thing, if you're looking at property portfolios, is do you actually know which buildings they have which are covered by an option? Do you know from what date that option was made? And do you have the evidence that that option was made with HMRC? And that's certainly, that evidential point is important. It's one the lawyers will certainly come back to anytime you've got a client who's saying they're going to charge VAT on it. The lawyers will be saying, well, what evidence have you have that there's an option in place? So when you come to that end of 20 years, as I say, I think it's a positive action that you need to think about taking, but don't rush into revoking it, because if you then a month later the client changes its mind, you've got to opt again, and that new option has another 20-year life. So in a sense, you've got slightly more flexibility if you just leave the option in place over the 20 years and carry on after the 20 years until you get to a decision point as to, yeah, actually, I will do the revocation and I will take the option away. Now, even if you've opted on the building, it doesn't mean necessarily that everything that goes on in that building will be taxable, because you might have, a block of flats with retail units below. If you own the interest in the building, you are opting on the whole building, but it only affects the VAT treatment of the rents that relate to the commercial properties. So yes, you've opted on the whole building and the option is covered for that 20 years on that whole of that building, but it's only going to affect the commercial elements of that building. And that's the same whether you're talking about the leases or ultimately the freehold disposal. So when you do get to a freehold disposal and you've got a mixed use building like that, you're carving out the value associated to the commercial, and it's that value that gets subject to VAT. And of course, don't forget, stamp duty calculations are on the VAT inclusive values. So once you've opted, does it mean that all the VAT is recoverable in that building? Well, no, the answer is it depends, doesn't it? Because we don't know if the building is used for 100% taxable use. So, in the example that I've put in here, if you've got a charity that buys a building and opts to tax, but moves into that building and operates it itself, that doesn't necessarily mean that all the input tax they incur, or perhaps on buying that building or renovating and looking after it, is going to be VAT recoverable. So it's not that there's an option on the building that protects the VAT recovery. We still look at, well, what is the use of that building? And if that charity has got non-business activities, which you would expect, it could have a percentage of non-business. It might have a percentage of exempt business activities from fundraising activities. Then that's going to restrict their VAT recovery. So an option to tax is not a sticking plaster that completely unlocks all the VAT recovery that you've got there. So what are we seeing as common mistakes? Bold for the first point, because this is the common error that gets made up. People go, oh, I bought this building. Oh, I was charged VAT on this building. Therefore, there's an option to tax. They don't do anything themselves, but they sublet part of it. It's a commercial element. They charge VAT on the rents. It's not the building that's opted. It's your interest in that building. And as I say, that might be the freehold interest and it covers the whole of the building, but it's not that the option passes through a transaction because it's stuck on the building. Every person who has an interest in that property has the opportunity to consider whether they want to opt to tax it. So I think that's a really important point just to get clarity on. It's your interest that's covered, not the option. And if you think about the logic of that, because I'm a bit of a logical person, if you opt on a building and you have the leasehold interest in it, and then you get rid of that, you surrender that leasehold interest, but then 5 years later, you get an interest in another part of the building, then you've still got that 20-year time lag running. So, you know, just be alert. That's why I come back to having a property asset register, so that you know what buildings you looked after, what were yours, when you opted, so that you could actually deal with monitoring and maintaining compliance over that 20-year period. So that's important to take account of it. So as I say, just recognize on that, if you've we did have a situation which I'll touch on in the case study that I've put in here. If you do find that you've got a client who's got just decided, oh, I was charged VAT, I'm going to carry on my subletting charging VAT, and they've never actually written to the revenue, there is the ability to ask for belated notification of that option to tax. And that's exactly what it says on the tin. You know, I'm sorry, guys, I'm late. I have opted. I have made that decision. I just forgot to notify you, because we have this 30-day period that we've got to notify the revenue from the date we've made that decision. And, you know, these are all things that do need to be documented. So, you know, if you've got a client and you're sort of advising, just be careful in terms of noting when they actually decided to opt to tax, when they made that decision, because that's when that 30-day clock starts to tick through. Now, HMRC may accept a belated notification. We've got a couple going on at the moment, but it's not a given if they feel that, you know, there's an element of risk to the revenue. The 2 points that are really important for you to look at if you find yourself in this situation is, what evidence have you got that the business had the intention to opt and make taxable supplies? You know, is that in their business planning? Is there an email back and forth to you where you said, oh yeah, you can recover the VAT if you opt to tax? Oh, right, I'll go and do that, you know, at some point. You know, how do you prove that they had the intention to opt to tax? Did they act as if they had opted to tax? Can you evidence the fact that they were charging VAT on those rents? What do the lease agreements with their subtenants say? So HMRC will certainly come back to them if you're in a belated notification position and ask for evidence that there was an intention to opt to tax in order to clarify. So it's the decision making and the notification process within those 30-day time limit. Now, you might find it a bit odd with this case study, but this is genuinely something that's come across our desk very recently. We had an owner-managed business that in 2014, it had 2 entities. Business A owned the warehouse, and that was leased to a tenant on a 10-year lease, and Business A had opted to tax. So they were charging VAT on that property, on those rents. A wanted to sell that to B. B was going to continue to lease the property to the existing tenant. So for those of you who are savvy in the audience, you'll be going, aha, we got a transfer of going concern here. Absolutely, you should be looking at TOGC, because that transfers the property as a business, as a property letting business, and it means there's no VAT due on the supply. It's not a supply for VAT purposes. But the really important thing on TOGCs when you're dealing with properties that are opted is the purchaser needs to opt on that building before they acquire any interest in that. So before there's any tax point or deposit paid, they must, in order to meet the conditions of a TOGC, they must have opted before they acquire the interest. And that's what Business B did. Back in 2014, it put its option to tax in on the building. However, they didn't actually go through at that point due to a funding issue. They didn't go through and buy the building until 7 years later in 2021. And they argued that they had done that as a TOGC so that there was no VAT due, because they thought opted building being sold, purchaser has notified the revenue of its option, end of conversation, no VAT due. It wasn't correct though. And the reason that it wasn't correct and that the TOGC argument failed is that there is a piece of the guidance notes which says if you do not hold an interest in that property for 6 years, that option to tax is automatically revoked. And HMRC don't need to write and tell you that fact, because it's written in the legislation that it's triggered. So when he actually did do the sale 7 years later and treated it as a TOGC, the purchaser didn't have a valid option in place. Okay. Is it fixable? It was. So we've got a very happy client, but it's really important that you don't make assumptions on the options to tax, and documentation and evidence are really important about that side of monitoring it. Now, I've put another couple of points in here about transfers of going concerns and options to tax, because I thought it was just useful to remind you that there are rules that need to be met in order for a TOGC to be valid. And please do recognise that a TOGC, it's a statement of fact. If the conditions are met, it is a transfer of a going concern. If it's a transfer of going concern, no VAT is due. If it's not a transfer of going concern, VAT is due on the taxable elements of the transaction. And the reason that I stress that to you is the fact that if somebody sort of can't be bothered to get proper advice and just goes, oh, I'll treat this as VATable and I'll count for VAT on it, and they charge their buyer VAT, if it genuinely was a transfer of going concern, the impact for the purchaser is that they might face that VAT on treated as input tax as being disallowed. So you can't, as the vendor, just go, oh, I'll charge VAT. I can't bother to work out whether it's TOGC. I'll play safe. I'll charge VAT, because your purchaser could end up in a situation where he gets a bill from the revenue because you've charged him VAT. He's tried to recover it, and the revenue have seen this big chunk coming through and says, I'm sorry, that's not VAT because that was a transfer of going concern. So it's not just about making sure it meets the conditions if it's a TOGC and you don't charge VAT. It's also about making sure if you say it's not a TOGC and you charge VAT, that it really isn't a TOGC. Okay. Now, I'd put in the bullet points a couple of conditions, as I say, use that as an aid memoir. The key ones, as I say, when we're dealing with opted properties, is all about, that date of the option by the purchaser, and making sure that what you're talking about is the same kind of business. So do make sure if you've got a business that you're treating as a property letting business and the purchaser's taken on board, that they're going to use it in the same way. And so you do need to look at the liabilities and warranties that you have to put in place to protect both parties, you as the vendor or you as the purchaser. But definitely something to look at when you're talking about the disposal of buildings. Certainly if it's been a property letting business where you've had tenants in it, and that's your argument that it's a business and it's being transferred as a business, you've got to have tenants in there really if you're transferring it. So it's not enough for the tenant to say, the new owner say, oh yes, I will use it in the same way. But actually at the point of transfer, there's no tenants in there. So think about how you're restructuring, your lease agreements if you're trying to get into the transfer of going concern. Okay. So, luckily for our client, we were able to resolve it for them. But it just goes to show how very easily, commercial reality takes over and causes us a problem on the VAT side. So I've mentioned this revocation of an option after 20 years, but I'm also sort of putting in the slide pack. There are times where perhaps you as the vendor will receive a notice, a VAT form. You can see them listed there, 1614 B, C, D, F, G. And that option that you've made will be disapplied because of the circumstances of the purchaser. On C, it might be that you, the vendor, are going to disapply because you've got a 6-month cooling off period from the date you make the option. You've got 6 months before you fulfill that intention, and you can revoke that option in that 6-month period. So there's 6 months at the start, other than it stays for 20 years, and you can revoke after 20 years. But I deal a lot with housing associations and charities. So, we can look at revoking and disapplying, I should say, the option to tax by a vendor, particularly my housing associations, which, as they are VAT sensitive and cannot recover VAT, that will be certainly something that they will look at to disapply the option. And what does that mean for you as the vendor? Well, it means you're going back to make an exempt supply of the land. And then that ripples back into what impact does that have on your VAT recovery position, because you've reclaimed all your VAT thinking you were right to do so. So a couple of things around that. The disapplication by the housing association doesn't come into play until you've had a discussion as to what the price is. So it might be you're selling it land for £1 million plus VAT, £200,000 of VAT. The housing association client wants to disapply your option. You've incurred VAT of £50,000 on your costs. So actually what you say to them, yeah, I'll accept your disapplication, but the price is not £1 million, it's £1,050,000, so that I'm not out of pocket. So these are all the things that need to come into a conversation when you're dealing with property transactions where options to tax are applied. Now, in the second section there, you can see I've put in things where an option can be disapplied, but you don't need a formal certificate or form. It might be you're selling land to an individual. It might be you're selling it for a building for use as a dwelling, or for relevant charitable use. So remember my charity example, they might come back and say, actually, I am a charity. I want to disapply your option because I'm going to use it for my non-business purposes. That's what the criteria is. So again, it's important to understand the implications of these aspects. There is a third aspect where the option to tax gets wiped away on that third bullet point, and that's about whether there's actually anti-avoidance provisions that come into play. So if you try and be a little bit too clever sometimes and opt to tax a building that the business owns, and then the business runs, I don't know, a chiropractor business, and it lets the building to the operating company that's doing the chiropractor, common directors, but the use is for an exempt purpose. The building is a capital item, and the option to tax is automatically disapplied. So watch out. There are a number of ways in which that option to tax can fall away. And remember, why is that important? It changes it from being taxable supply back to being exempt, and that has a negative impact on VAT recovery. Okay, final point I think on disapplication is there are some ways in which an intermediary in a supply chain on land can actually take advantage of the disapplication. So like my housing example case, if the land is owned by, say, a farmer, and they sell the land to a developer, and the developer knows they're going to sell the land onto a housing association, then the housing association could disapply the option from the developer, but the housing association can't disapply the option from the farmer because they're not buying land from the farmer. But there are certain ways in which an intermediary can benefit, but it's not on the buying and selling of land. It's on property that's going for conversion. So it's an existing building. So again, just to flag up that there are some ways where even the role as an intermediary can create a situation which is of benefit to disapplying the option. A final point on housing associations is, should any of you advise housing associations, just to make sure they use the right form when they're issuing it in the right circumstances. So I won't go through that because I'm conscious of time, but just be alert to that. So hopefully there was something in there that was a sort of, oh yeah,
yes,
I've forgotten about
questions, that. Liz.
Fire away, Pete.
Right. Is it compulsory, Ahmed? Thank you for this. Is it compulsory to opt to tax on purchase of the building in order to claim the VAT on purchase, or can it be claimed under capital goods scheme, in which case the time limit is 10 years? Right.
The answer to that question, Ahmed, is if you're trying to recover VAT on a building that you bought or the client has bought, you've got to demonstrate that that client is going to use it for 100% taxable purposes. Now, if it uses it for an exempt business purpose before it uses it for a taxable purpose, obviously you've got a little barrier, haven't you? Because the VAT on the cost of buying it, the first thing it hits is an exempt supply, an exempt use. So I think you need to look at the circumstances in the round. It's not enough to say, oh, I incurred VAT 10 years ago. Now I'm going to opt to tax 10 years later and I'll claim the VAT back because I'm within the 10-year period. what was the use of that building in that intervening period? And if there's exempt use in there and non-business use, you're certainly not going to. And remember, the capital goods scheme doesn't give you 100% of the original VAT back. It gives you 1/10 of the remaining intervals. So if you've got 3 years left on the capital goods scheme 10-year period, you're only going to get 3 years of taxable use. So you're only going to get 3/10 of the VAT that was incurred originally. So I think it would be very dangerous to do a blanket sort of, oh, don't worry, guys, we'll leave this because I can claim it back under the capital goods scheme. Capital goods scheme doesn't work like that.
Thank you. Another one from Emma. If a VAT registered hotel business is about to be sold as a TOGC, including property, then I assume the owner needs to opt for tax before the sale.
No, not necessarily. It's because what you're selling, you meet the criteria of it being a business in its own right. So the assets that get transferred under that umbrella, it's the hotel building. It's part of the transfer. If it's not opted, it can still be a TOGC. Yeah. It's only if it's opted by the vendor that you have to make sure the purchaser opts. So there's not a compulsion to make you opt to tax in order to get into TOGC. A building can go exempt to exempt and still be a TOGC. Yep. If it's a business.
Yeah, jolly good. Amanda has got a very, I think this might be a bit complicated and might be something you want to do afterwards. What are the VAT implications at each stage when a Chinese company shifts £200,000 worth of TVs to a warehouse in Germany, and later the TVs are sold through an electronic selling platform to a customer in France? The platform owns the warehouse. I think it's something we'll have to think about. Right, and we'll go back to Mandy afterwards. It's quite a complicated issue, that one.
It's quite complicated, but if I just deal with the basic premise of that for you, just remember that the place of supply is where those goods are when they are sold. So if those goods are owned by a UK entity, let's say, or even owned by a Chinese entity, and they are in a warehouse in Germany, if they are sold out of that warehouse, then the place of supply is Germany. And therefore, you'll be VAT registered in Germany. So I think if I leave that there, because there are some added complications if you're selling B2C, B2C, B2B, etc. But if you just remember that fundamental thing, it's where the goods are when they are sold that triggers the place of supply.
Yeah, which always reminds me of the wonderful one of Sky, who tried to claim that it was on the satellite, so therefore you didn't have to have any charge until they changed that one. Anyway, carry on. Thanks. Back onto that.
Cheers. Thanks, guys. Right, education. Conscious of time, so just a quick update. A bit of upheaval, put it mildly, isn't it? VAT on the independent school sectors. Now, this is an example of unintended consequences when I talk about the impact elsewhere. But just to sort of say, yes, we've got VAT on independent school fees. There's a court case going through in the High Court. That's sat. The court has reserved its judgment, and we're waiting for that decision to be published. And that's about all sorts of, unfair, discriminatory behaviour. But it might be something that is relevant to your faith schools. A number of you might sort of help and support faith schools around. It's taken by 7 parents effectively, but it's also supported by the Independent Schools Council. So there's a lot of politics at play in here, but it's ongoing. But we are where we are, as they say, and we're dealing with VAT on school fees. Now, please, whatever you say to your clients who are in business and are putting their kids through independent schools, please do not say to them, don't worry, guys, you can reclaim that VAT back through your business, because that is not going to happen. Okay. So I have actually, when this first came up, I had an accountant say, oh, well, I told the client it's not a problem because he's VAT registered and he claim it back. No, doesn't work like that. So just take that point on board. But again, the ramifications elsewhere. There's a potential impact for our FE colleges, because what an FE college is, its provision of education has always been regarded as a non-business activity, where it's to non-fee paying students, so grant-funded students under the age of 19, was historically felt to be a non-business activity. Colchester Institute VAT case came along, and some VAT advisors running that wanted to argue, for Lennart's reasons, nothing to do with the liability here. For Lennart's reasons, they wanted to argue that that supply to those students was a business activity. And Colchester was successful at that point. There is another Colchester 2 case going through. That was quite a wide-ranging impact for the FE sector, because FE colleges get a lot of VAT relief on their fuel and power bills. They only pay at 5% because they're a charity and they use that energy for non-business purposes. And what this case was saying, hang on, that education is now a business activity. So they were the risk was they get 20% VAT on their fuel and power. And more importantly, they were also faced with getting 20% VAT then on any new construction of study areas for students, because they couldn't argue it was the new construction of a building for relevant charitable use. Because yes, they were a charity, but this case was saying their provision was a business activity. Now, if you roll that forward through to 2025, the law is saying that VAT must apply on tuition fees to the majority of learners up to the age of 18. Well, that's your FE college market, and they are paying tuition fees. I'm going to do that inverted commas bit, watch out. Tuition fees, because that's the consideration, is the grant, that's the fee income they're getting. So there is the risk, which would be quite a chunk of taxation and problems for the FE sector, that the argument of the independent fees VAT change is that VAT is due on the grant element they get from government to fund their students up to the age of 19. So that's going to be a law of unintended consequence. But yeah, we obviously deal with a lot with FE colleges. Not everybody does, but it just shows you how these things can ripple through. And, perhaps are not what you thought you wanted at the end of the day. There is a business brief that basically allows FE colleges to continue to treat their supplies as non-business. But obviously Colchester is arguing and has argued it's a business supply. So a quick bit on that. In the vein of checking on academic education, I'm just alerting you to the impact on academies. So academies are different again. They were set up as what we call Section 33 bodies. Section 33 of the VAT legislation defines a certain number of entities that are treated as non-business, but have the ability to recover VAT on their costs, even though those costs support their non-business activities. I am certainly seeing, and I have a colleague who will be speaking at the Multi-Academy Trust Conference in October on this point, because we're seeing a number of academies that either aren't VAT registered that should be, because they think all their activities are non-business, and they're forgetting all the things they do that actually are business supplies and are taxable. So that's the other issue. And we're also seeing challenges from HMRC to those trusts that are VAT registered. And the challenge that the revenue is making is, prove to me you're not recovering VAT in areas that you shouldn't be. So prove to me that if you've got exempt business income from room lettings, which a number of them have, prove to me that you're doing a partial exemption calculation and not just going, I'm a Section 33, all the VAT I incur is recoverable, end of conversation. So there is an issue there for those of you who support academies. And as I say, Drew, my colleague, will be speaking in October. He's actually also, if anybody is near our Stockport office on the, just check the date, on the 19th of June, he's running a session there for academies. I can't open the invitation to accountants and advisors, but if you've got academies, he will be speaking and running a little session on there, which is free to access. So if you want to signpost that, and he'll be running that in Sittingbourne in Kent and also in our Preston office as well. So there's a couple of touch points that you can pick up. But yeah, 19th of June, he's in Stockport. The other free to access thing that you can do is we have an annual VAT forum for housing associations, universities and colleges, online, 2 hours online, free to access. If you go onto our events page on the Zenadin website, you know, anybody, doesn't have to be a client. Clients, you know, can join, but non-clients can join as well. Okay, so take advantage, you know, the stuff that's out there that you can access free and clients can get hold of free. Right, last 5 minutes. Where am I got to? EU changes. As I say, I'm literally just going to gloss over these. There have been some changes. They started from January 2025. They're about place of supply, because that's, you know, when we're talking about whose country's VAT is due, it's determined on, well, where's the place of the supply. So there's a place of supply change coming as a result of VIDA, the VAT changes from the European Union. There's a gradual series of changes coming through, but these certainly came in from the start of this year. So just touch base with any clients who are doing B2C online events, training, to make sure they're not caught by the e-services rule change that's coming on Europe. So just watch out for that aspect. And as I say, there's also, which might link perhaps up with the earlier point, about goods moving around within the EU. There's a single registration where you've got businesses that have got goods moving from one EU country to another EU country. We used to have to face multiple VAT registrations, but now there's a single simplified return. Okay, so a couple of bits and pieces in there. Finally, because this is important, and I know, I'm sure I can put money on the fact that a lot of you are involved with clients in this. Do make sure, I would ask for a hands up. I hope people have been alerted to this, but if not, there was a business brief that came out in April. There has been a scheme. I'll call it a scheme because frankly, it is a scheme. And it looks at restructuring the way in which residential care provision is undertaken to move elements of that provision out of the VAT exemption into being a taxable business supply. Now, clearly, you're all intelligent people, you'll know why that is being done. It's because if you can make a taxable supply to a person who's able to recover that VAT, everybody's fine on that side, and you, the supplier, get the benefit of recovering the VAT on your costs. So all your nursing home clients would be going, oh, this is very interesting. Now, we haven't been promoting this scheme. It's entirely up to you what your view of it is. But my concern was it was the deliberate restructuring point, which again picks up the point that Pete raised at the outset in terms of furnished holiday lets and how you restructure things. You know, you've got to have some commercial reality to these things. Now, the mechanism that this works around uses a VAT group, where you've got a state registered provider of care, which is your traditional care provider, but then you have an entity in that VAT group that is not state regulated. And because the supply is made by the unregistered provider, that is what makes it taxable. And it's a supply on council funded places or NHS care board funded places, and they're able to recover the VAT. So the supply to the private residents carry on being exempt through the state regulated. It's a supply to those other entities that can recover the VAT that becomes taxable. But it's very clear from that notice that new applications for VAT group will be scrutinised and challenged. Existing VAT group structures will also be investigated. And if you are an auditor, then I clearly would be advising you to take account of what element of a provision you might need to put, and is it material in terms of VAT that has been recovered by an operator that you are auditing using this mechanism. Now, I'm sure the promoters will say this is not an avoidance scheme. That's absolutely fine. There's an argument to be had. My role is to make sure you're informed as what risks your clients face. So that's it, boys and girls. It's 1 minute to the hour of. You have my contact details. I'm happy to sort of stay on for as long as Carly and Pete want me to. But Pete, I'll hand back to you.
Yeah, thank you very much for this, Liz. It's been very interesting. Lots of wide-ranging issues and problems I can always see. We have a couple of questions, but I think what I'll do is I'll give you the details of the people and we'll go back to them from there. That's probably the easiest way of doing it. Next, let's go back to stage again. Just a reminder, slides and recording will come out tomorrow. We'll put some things together. I'll have a quick chat with Liz because there might be some other bits I need to add to this. Our next webinar is on the 18th of June with a company called Rand, who do a lot of R&D work, and it will be on current issues within the R&D and how it's all changing and things. So it'll be quite an interesting problem there. But I'd like to thank Liz for doing this talk and you all for coming, and hopefully we'll see you in a month's time. Thank you very much, people.